What if I told you there's a way to create a six-figure retirement income while paying zero taxes on it? And no, this isn't some sketchy tax scheme. It's completely legal and it's been hiding in plain sight. I'm about to blow up everything you think you know about retirement planning. See, the personal finance gurus out there will tell you that whole life insurance only makes sense if you're worth at least $11.4 million. But what if I told you that's complete nonsense? What if I showed you how regular people, not ultra-wealthy folks, are using whole life insurance to build tax-free retirement income streams? Stick around because I'm going to share a real story about a guy who created a six-figure retirement income and literally pays zero taxes on it. Plus, I'll show you 3 specific strategies you can use even if you're not rolling in millions. The shocking truth about online financial advice. I've been in this industry for a long time, and the misinformation about whole life insurance online is absolutely mind-blowing. One of the top-ranked personal finance websites literally claims whole life only makes sense for people worth over $11 million. Where did they even get that number? It's like they just threw a dart at the estate tax exemption threshold and called it a day. Here's the thing. I've been trained by large mutual companies. I've been licensed to sell securities. I've seen the sausage-making process of financial planning from the inside. And let me tell you, most of the people we help with whole life insurance are nowhere near ultra-wealthy. They're people with above-average incomes and above-average financial discipline, but they're not millionaires. So let me tell you about this conversation I had a couple years back. I was at a meeting with other financial professionals, and I met this guy who'd been following our content for years. We started talking about how hard it is sometimes to get people to understand what we're teaching. And then he told me about his father. This guy had been in the life insurance industry for decades, and instead of loading up his 401k like everyone tells you to do, he focused on funding life insurance policies. Here's where it gets interesting. This father had created a six-figure retirement income using nothing but the cash value from his life insurance policies. And when his son looked at his tax return, the only reportable income was Social Security. Zero taxes on his investment income. Zero taxes on his pension income. Why? Because there wasn't any. His entire retirement income came from life insurance policies he'd funded over his working years. And don't miss this, because policy loans don't count toward provisional income calculations, none of his Social Security was taxed either. This guy was living large in retirement and the IRS couldn't touch him. Now, is this right for everyone? Probably not, but it shows you what's possible when you think outside the conventional wisdom box. All right, let's get into the nuts and bolts. When you own a whole life insurance policy, your premiums build cash value. Not all of your premium goes to cash value. Some goes to insurance costs, but a portion does accumulate. Here's the beautiful part. You can access this cash value at any time for any reason. You don't have to die to use it. And you have 2 ways to get at it. First, you can withdraw cash directly from the policy. This is permanent. Once it's out, it's out. You're typically surrendering paid-up additions, which means those pieces won't earn dividends anymore. Second, and this is where the magic happens, you can take a loan against the policy. The insurance company lends you money, and you pledge your cash value as collateral. The cash stays in your policy, continuing to grow while you use the loan proceeds. This is how that father I mentioned was getting his tax-free income. Policy loans aren't considered taxable income because technically it's borrowed money. Strategy number 1, the qualified plan alternative. Now, everywhere you turn in personal finance, they're telling you to max out your 401k, your IRA, whatever qualified plan you have access to. The logic seems sound: defer current income, pay no tax now, let it grow tax deferred, then pay taxes later when you're hopefully in a lower bracket. But here's what they don't tell you. What if you're not in a lower bracket? What if tax rates go up? What if your other income sources push you into higher brackets anyway? We take a different approach. Instead of putting all your eggs in the defer everything basket, what if you diversified your tax treatment? Think about it. With qualified plans, you're making a bet that you'll pay less in taxes later. With whole life, you're paying taxes now on the premium with after-tax dollars, but everything that comes out later is tax-free. It's like having a Roth IRA with no contribution limits and no required minimum distributions. Strategy number 2, income source rotation. You've probably heard of the 4% rule, right? The idea that you can safely withdraw 4% of your investment portfolio each year in retirement without running out of money. Here's the problem with that. What if the market crashes in your first few years of retirement? What if you're forced to sell investments at a loss just to pay your bills? This is where whole life insurance becomes incredibly powerful. Instead of blindly following the 4% rule every single year, what if you got strategic about where you pulled your retirement income from? Here's the concept. Fund both traditional investments and a whole life policy during your working years. Then in retirement, take income from your investment accounts in the years when markets are up, and take income from your whole life policy in the years following market downturns. This approach would have smoothed out the volatility and potentially increased your overall retirement income. The key insight is that life insurance companies invest conservatively. They're regulated on how they can invest, and they tend to be steady and predictable. While dividend rates can fluctuate, they don't crash like stock markets do. This creates what we call non-correlated returns. When your stocks are getting hammered, your life insurance cash value is chugging along steadily. Strategy number 3, the income annuity play. Here's a strategy almost nobody talks about anymore, using your whole life cash value to buy an immediate annuity. I know, annuities aren't sexy. The returns aren't spectacular in today's low interest rate environment, but here's what they do provide. Absolute guarantee of income for life. Let me give you a real example. A 65-year-old male using a 1035 exchange to move $300,000 from a whole life policy into a single premium immediate annuity. With an installment refund feature, meaning if he dies before getting all his money back, his beneficiary continues receiving payments until the full amount is recovered. The result? About $1,500 per month for life, guaranteed. Now, many people look at that and think they can do better. They don't want to give up control of their money. But here's the thing, this is guaranteed income. No market risk, no sequence of returns risk, no what-if scenarios. It's money you can count on every single month until you die. Here's something most financial advisors won't tell you. Whole life insurance actually makes your overall portfolio more efficient. Adding whole life to a traditional stock and bond portfolio improves the risk-adjusted returns. It's not just about the returns themselves, it's about getting better returns with less volatility. Think about it. You've got stocks that can swing wildly, bonds that are getting crushed by inflation, and then you've got whole life providing steady, predictable growth with tax advantages and liquidity. It's true diversification, not just owning different types of stocks and calling it diversified. Look, I'm not telling you to dump all your money into whole life insurance. What I am telling you is that the conventional wisdom about whole life being only for the ultra-wealthy is complete garbage. The 3 strategies I've shared today, using it as a qualified plan alternative for income source rotation and as a platform for guaranteed income, these are real strategies being used by real people who aren't worth tens of millions of dollars. The key is understanding that whole life insurance isn't just insurance, it's a financial tool. And like any tool, it works great when used properly and terribly when used incorrectly. If you want to see how this might work in your specific situation, I've got a whole life insurance calculator linked in the description. You can plug in your numbers and get a rough idea of how the math might work for you. And if you found this valuable, hit that like button, subscribe for more contrarian financial wisdom, and let me know in the comments. Are you using whole life insurance as part of your retirement strategy, or is this the first time you're hearing about these concepts? Thanks for watching.